Most people hear the words stock market and immediately feel a small sense of distance. It sounds technical, complicated, like something meant for economists, traders, or people who already have a lot of money. But the stock market is not built for experts. It is simply a system where ownership in businesses is bought and sold. When a company wants to raise money to grow, it can divide itself into small pieces called shares. Those shares become available for investors to buy. When you buy one, you own a small part of that company. If the company becomes more valuable over time, the price of that share can increase. If the company struggles, the price can fall. That movement in value is what people refer to when they talk about the market going up or down. This is the basic foundation of investing: ownership, growth, time. Beginners often believe investing requires predicting which company will become the next major success. That idea is popular because it is exciting. It creates the image that investing is about spotting the one opportunity everyone else missed. In reality, consistently choosing individual winning stocks is extremely difficult. Even professional investors who spend their careers analyzing companies often struggle to outperform the overall market. Because of that, many long-term investors use a different approach. Instead of trying to pick the best company, they invest in the entire market through index ETFs. An index ETF is a type of investment fund that holds many companies at the same time. Rather than buying one stock, you buy a single fund that already contains a wide collection of businesses. These funds usually track a market index, which is simply a group of companies representing a section of the economy. For example, some index ETFs track the largest companies in the United States. Others track global markets. Some represent hundreds of companies across different industries: technology, healthcare, finance, manufacturing, consumer goods. When you invest in an index ETF, your money is automatically spread across all of those companies. This diversification reduces the risk that comes from relying on a single business. If one company struggles, the others continue operating. Over time, the overall market tends to reflect the growth of the economy itself. For beginners, this structure removes one of the biggest challenges in investing, which is deciding what to buy. Instead of constantly analyzing individual companies, the investor participates in the growth of many companies at once. The process of starting is straightforward. A brokerage account is required first. A brokerage is simply a platform that allows investors to buy and sell financial assets. After opening an account and depositing money, investors can purchase shares of stocks, ETFs, or other investments directly through the platform. Once the account exists, the focus shifts to how the money is invested. Many beginners choose to start with broad index ETFs because they provide exposure to a large portion of the market in one investment. This creates immediate diversification and keeps the investment strategy simple. The long-term performance of major stock markets historically shows gradual growth over long periods of time. Although the path is rarely smooth, prices move up and down regularly. Some years produce strong gains, others produce declines. This volatility is a normal part of financial markets. New investors often feel uncomfortable when prices drop because it creates the impression that something has gone wrong. In reality, temporary declines are part of the same system that produces long-term growth. Markets adjust constantly as new information enters the economy. For investors focused on long-term participation rather than short-term trading, these fluctuations become less important. The focus shifts away from daily prices and toward gradual accumulation of assets. Many investors approach this by contributing money at regular intervals. Instead of trying to predict the perfect moment to invest, they invest consistently over time. This approach allows them to participate in both market highs and market lows without relying on precise timing. Another concept that becomes important over time is compounding. When an investment grows, the gains remain invested alongside the original money. Future returns then apply to the larger amount. Over long periods, this process can accelerate the growth of an investment portfolio. Compounding works slowly at first. Early progress often looks small. Over longer time horizons, the growth becomes more visible because returns begin building on previous returns. While long-term investing focuses on holding assets for years or decades, stock market trading follows a different approach. Trading attempts to profit from short-term price movements. Traders analyze charts, patterns, and market behavior to make decisions about when to buy and sell. This style requires significantly more time, study, and emotional control. It also carries higher risk because outcomes depend on short-term price changes that are difficult to predict consistently. For beginners, it is often useful to understand the difference clearly. Investing focuses on long-term ownership of businesses, while short-term opportunities created by price volatility. Learning about trading can be valuable, but it usually requires deeper experience with market behavior, risk management, and psychology. Many beginners begin with long-term investing first before exploring trading strategies later. Over time, the most important factor in investing tends to be consistency rather than complexity. Markets reward patience more often than speed. The individuals who build significant long-term portfolios are usually the ones who remain invested through multiple market cycles rather than reacting to every short-term movement. Understanding the stock market does not require mastering every financial concept immediately. The system itself is built on a few simple principles. Companies grow by producing value. Investors can own shares of those companies. Markets fluctuate in the short term but tend to reflect economic growth over long periods. Index ETFs allow beginners to participate in that growth without needing to predict individual winners. By spreading investment across many companies, they simplify the process and reduce the reliance on constant decision-making. In the beginning, the mechanics may feel unfamiliar. Prices move constantly, news influences markets, information appears overwhelming. But beneath that complexity, the core idea remains straightforward. The stock market is a system where individuals can gradually build ownership in the productive parts of the global economy. Over long periods of time, that ownership has historically been one of the most reliable ways to grow wealth. If you liked the video, please subscribe to USD FinPath.